Are you wondering what kind of loan you're going to get for your first house or maybe an investment property? Well, we'll be going over that today, so stick with me. Hi, I'm Emmanuel, and welcome to If I Can, You Can, where if I can do it, you can do it too. Now, as always, if you like this content, please like and subscribe below and leave me comments. I love reading through them. But today we're going to be going over the different types of loan products and how you qualify for each with the down payments that are required for each one also. So, let's get into it. First one is conventional loans. All this is a normal loan that is not backed by the federal government in any way, so there's no real program behind it. Typically for a down payment on these, it'll be between 5 and 20%. However, if you put down less than 20% towards the loan, they're going to require you to put PMI, which is private mortgage insurance. And all that is an insurance, a guarantee that if you stop paying and they have to foreclose, it's kind of an insurance that they get something paid back, so they're not out of pocket for giving you that loan. Now with these, to qualify, you'll typically need at least 620 credit score and above. Now these come in two different options for interest rates. One is fixed and the other one's adjustable. All that fixed means is that for the life of the loan, that interest rate is not going to change. That is normally what I go through when I put down you might save a little bit of points by going through adjustable, but fixed is what I normally use because it's set in stone. It's not going to go up or down with the market, and this is how a lot of people got in trouble in 2008. So be careful with this. Now, adjustable may have limits of how high or how low it can go, but all that means is that that interest rate will adjust with the market and with the interest rates that the bank set. So keep in mind those options when you're selecting them. I recommend one over the other. And then there's FHA loans, which stands for Federal Housing Administration. A lot of people think that this is first-time home buyer or something else, and it isn't. All this means is that it's backed by the Federal Housing Administration, and this is to target low to moderate income earners. What does that mean? Well, it means that you have a lower down payment then. Instead of it being 5% minimum, now it's 3.5%. And the people that can't come up with that extra 1.5% or 20%, which is a ton of money, it makes them able to go and purchase a house. And it also allows for a lower credit score too, as low as 580. With this, if you pay anything less than 20%, it's still going to be the same rules as conventional though. You're still going to have to come out with insurance towards the loan. Instead of being called PMI this time, it's going to be called MIP this time, which is going to stand for Mortgage Insurance Premiums. That's going to stay on to your loan. You're going to have to pay for that too until it drops down to, I think it was 78%. With this loan product though, unlike the conventional where you can go get a conventional for an investment property or whatever you kind of wanted to buy for, you're going to have to live in that property for the first year. And that's generally what is written into the contract, is at least a year inside that property. And then you can leave and rent it out to somebody else and turn it into an investment property. But you can only get one FHA loan. So it's not that you go put 3.5% down and then go buy another one for 3.5%. No, it doesn't work like that. You have to get one and then either refinance out of that loan into another loan product, or you just can't get another loan product like that and have to go with something else. And then there's the VA loan. That stands for Veteran Affairs. What this is backed by the Department of Veteran Affairs and it's meant for exactly that. Veterans and people who are serving in active duty. This gives them a capability of buying their homes. Now, it has very, very, very good benefits to it. It's down to 0% down. I ended up using one of these. It was amazing. I really only had to come to the table with closing costs. It was a very, very good loan. And there's a lot of things that you can get for benefits that you don't have to pay certain fees that you would otherwise need to. The difference with this product Versus the other ones though, is that there is no PMI on a VA loan. That means you don't have to pay extra money to pay for the insurance. It's backed by the federal government on the VA side. It's a much, much better product. However, unlike the FHA loan in this respect, is that you have a limit depending on where you are in the country. And let's say it's $750,000 and you go buy a home for $350,000. Similar to the FHA loan, you're going to have to live in that house for at least a year and show intention of living there as your primary residence. But after that, you still have $400,000 remaining on that loan. You can go out and buy another home and rent out your first one and have a second loan product for the VA. And then anything above that, you have to guarantee it by 25%. There's numbers on it, you can get into it. But you can also use this loan product on anything between 1 and 4 units. That, I'm pretty sure it's the same thing with the FHA loan, but that's a really good way to do it for 0% down, buying a quadplex or a duplex or a triplex, renting out the other ones with 0% down. Absolutely incredible. There's also the USDA loan, which is the United States Department of Agriculture. I have never used this loan product. I've heard of it, but not much. What this is meant for are people that are low to moderate income earners that want to buy properties in rural areas. And it's a really good program. It has 0% down, but it also has some requirements behind it. It has maybe income limits depending on what the area is. On your medium income for that area, it can't exceed a certain amount. You're going to have to pay a mortgage insurance just like the other ones, which is going to require an upfront fee, and then it's going to require a monthly fee on that too. And then for the credit limit, it's going to require a 640 or above. Now for this, what they're doing is they're protecting against people that are going to walk in there that have $200,000 a year and they're buying a property and they want to put 0% down on it out in the middle of, farmlands or whatever it is. This is really meant for people that don't have a lot of money to be able to buy their first property and live in it. We also have DSCR loans, which is debt service coverage ratio loans. Unlike the other loans where how much you earn really dictates how much they can give you, this has nothing to do with that. What this is it looks at a rental property. This is primarily for rental properties. It's going to look at how much money that property can bring in, and then how much that loan is in comparison to how much rent you can bring in. And if it goes over a certain ratio, then they will give you the loan with a down payment and everything else that comes with it. This is going to have a much higher down payment, 20 to 30%, and it's going to have a higher interest rate because this isn't your primary residence. And you might be wondering, why is it higher for investment properties than your primary? The whole reason to that is if you live in that property, it is very unlikely that you're just going to say, you know what, the heck with it, I'm going to stop paying and go homeless. That's a rarity. The banks know this. They're pretty sure that you're going to stay in the home to the best of your ability. However, it's not the same with a rental property. It's less likely that you care if you lose it completely because you still have a place to stay. If you say, hey, I bought this property, you know what, it's not working out, I don't want to do it. And it just blows my mind. There's people out there, but there's people out there that do this. And they just say, hey, you know what, take it back. Now they have to go and foreclose on the house, go through this whole process. It may be trashed out. They're not in the business of rehabbing houses and selling houses. They're in the business of making loans and being a bank and doing bank things. That's why the risk is so much higher for the bank, and that's why they cause a lot of problems with having higher interest rates on investment loans rather than your primary resident loans. And finally, there's jumbo loans, which are loans that are exceeding the conforming limits for Fannie Mae and Freddie Mac. All this is a very, very expensive property that you're buying, and it's more expensive than anything else that they were expecting. However, you're going to need to come in with a higher down payment and a higher credit score. Generally, you're going to need at least 10 to 20% for your down payment and you're gonna need at least 700 on your credit score to qualify for these. But now that I went over all of these, look into which one best suits the thing that you're trying to do. If you're trying to look for a primary residence and then have an investment property in the same year, that's a possibility you can do. You can use all these different loan types and make strategies to them and see what best works for you. Heck, I was saying earlier, maybe it's best for putting down 3.5% or 5%, getting to a home, fixing up, adding some value to the property, and then eventually renting that out next year. Meanwhile, you put down 20% somewhere else, buy an investment property on a DSCR loan, and you have an income producing property, and then you buy another primary residence somewhere else, and guess what? You just keep on building onto those and refining out of one into another. It all depends on what you can pivot and what you can do, and frankly, what you can afford. And that's all I have for today. So if you like this content, please like and subscribe. If you want to tell me anything I missed or let me know I messed something up, heck, leave it in the comments. I want to hear about it. But for right now, that's all I have, and I'll see you in the next one.